The biggest opportunity in crypto right now might not be Bitcoin's next move, but everything happening around it. While retail investors are giving up on altcoins, institutional adoption is accelerating. While headlines focus on short-term volatility, some of the largest financial institutions in the world are quietly building blockchain infrastructure. And while many are preparing for another crypto winter, multiple market indicators are beginning to flash signals that historically appeared near major turning points. Today, we're connecting the dots between Bitcoin dominance, Ethereum's positioning, XRP's institutional momentum, tokenized real-world assets, and why some analysts believe the next phase of the market may look very different from the last cycle. This video is for educational and informational purposes only and should not be considered financial advice. Always do your own research before making any investment decisions. Welcome back to Ledger Pulse, your source for the biggest developments shaping the future of digital assets, blockchain infrastructure, and institutional finance. If you're interested in understanding where crypto markets are headed and how traditional finance is merging with blockchain technology, make sure you're subscribed. One of the most interesting charts circulating this week isn't Bitcoin. It's the Others D chart. For those unfamiliar, Others D measures the market dominance of altcoins outside of the largest crypto assets. According to several market analysts, Others D has recently reclaimed the 200-day moving average and established a close above a key technical resistance level. Historically, previous recoveries above this long-term trend line have preceded substantial altcoin expansions. The psychology is fascinating. Markets often reward patience precisely when most participants have lost confidence. After months of sideways action and declining sentiment, many investors have reduced exposure or exited altcoin positions entirely. Yet some analysts argue that this widespread pessimism may actually be part of the setup. Whether history repeats exactly remains to be seen, but the chart structure has recently attracted attention. Another major discussion revolves around Bitcoin's monthly Heiken Ashi candle. Analysts noted that May closed green following a prolonged period of downside pressure. Historically, green monthly Heiken Ashi reversals following extended bear market conditions have often marked important transitions in the market structure. No indicator is perfect, but market participants closely watch these higher timeframe signals because they filter out short-term noise and reveal broader trends. If Bitcoin continues to establish higher highs and higher lows throughout the coming months, this signal may gain additional credibility. The key takeaway is not certainty, it's probability, and probabilities appear to be improving compared to where they were several months ago. Several analysts have pointed out that the BTC dominance has formed a technical death cross, an event that has appeared only rarely over the past decade. Historically, periods following Bitcoin dominance peaks have often coincided with capital rotating into altcoins. That doesn't guarantee an immediate alt season, but it does suggest that investors should pay close attention to whether liquidity begins flowing beyond Bitcoin. The market has changed significantly since prior cycles. Institutional participation is larger, regulation is evolving, tokenization is becoming a major narrative, yet capital rotation remains a recurring feature of crypto markets. If dominance begins trending lower while total market capitalization rises, altcoins could benefit substantially. Another chart making rounds this week shows Ethereum approaching a potentially historic milestone. Ethereum has never closed 3 consecutive red quarters. If current market conditions persist, this could become the first occurrence. For Ethereum supporters, this represents both a challenge and an opportunity. On one hand, prolonged underperformance raises questions. On the other, major turning points often emerge when sentiment reaches extremes. Ethereum remains one of the dominant smart contract platforms by many metrics, but competition has intensified. The coming quarters could reveal whether Ethereum regains leadership or whether market attention shifts increasingly toward alternative ecosystems and tokenization-focused networks. One of the most significant developments may have received less attention than it deserves. JP Morgan CEO Jamie Dimon, long known as one of crypto's most vocal critics, recently acknowledged that blockchain technology could eventually replace portions of today's financial infrastructure. That's a remarkable statement considering the source. But what made headlines wasn't just Dimon's comments about blockchain. It was his increasingly public frustration with the direction Washington appears to be moving. During recent discussions surrounding digital asset legislation, including the proposed Clarity Act framework, Dimon directed criticism toward Coinbase CEO Brian Armstrong and the broader crypto industry's push for regulatory certainty. Many observers viewed the exchange as unusually emotional. For some market participants, the optics were difficult to ignore. On one side, you have Brian Armstrong, spending years lobbying for clear rules, regulatory definitions, and a framework that allows innovation to remain in the U.S. On the other side, you have representatives of the traditional financial system attempting to preserve existing infrastructure and competitive advantages. The irony is hard to miss. While Dimon publicly criticized portions of the crypto industry, JP Morgan itself has spent years investing billions into blockchain development, tokenization initiatives, digital settlement systems, and distributed ledger technology. In other words, Wall Street appears increasingly convinced that blockchain is the future. The debate now centers on who will control that future. Will it be open public networks, or will it be private institutional systems? Or will the next generation of financial infrastructure involve both working together? That's the question regulators, banks, and the crypto companies are all fighting to answer right now. And perhaps the most telling detail is this: the conversation has evolved beyond whether blockchain works. That argument is largely over. Now, the battle is about ownership, market structure, and who gets to build the rails of the next financial system. Think about the current financial system. Wire transfers often operate within limited hours. Cross-border settlements can require multiple intermediaries. International payments remain expensive and slow in many regions. Blockchain networks offer something fundamentally different: 24/7 settlement, near instant finality, global interoperability, and reduced friction. Whether through private ledgers, public blockchains, or hybrid models, major financial institutions increasingly appear to be moving toward digital infrastructure. The debate is no longer whether blockchain has value. The debate is which blockchain systems will capture that value. And while that battle continues in Washington and on Wall Street, institutions around the world aren't waiting for the final answer. They're already building. Which brings us to one of Ripple's most important international partners and a major development coming out of Asia. A major milestone arrived from Asia this week. SBI Holdings officially completed the transition of Cambodia's former Amrit Bank into SBI Bank Cambodia. What's especially noteworthy is the continued integration of Ripple-powered international payment solutions. For years, SBI has been one of Ripple's strongest strategic partners. Their relationship extends beyond investment. It includes active deployment and real-world payment infrastructure. As global remittance corridors continue modernizing, institutions are increasingly seeking faster and more cost-effective alternatives to legacy settlement rails. This is where Ripple's technology continues attracting attention, not through speculation, through utility. Veteran trader Peter Brandt generated discussion after suggesting that if he had to choose one crypto asset most likely to become highly transactional, XRP would be his pick. Whether viewers agree or disagree, Brandt's comments matter because of his reputation for identifying major market cycles. The larger point isn't necessarily about price, it's about function. If blockchain adoption continues expanding into payments, settlements, tokenized assets, and liquidity provisioning, transaction-focused networks may become increasingly important. The question becomes, which assets are positioned to serve institutional demand? That's what markets are attempting to price in today. One of the biggest stories this week involves the DTCC. For those unfamiliar, the Depository Trust and Clearing Corporation processes quadrillions of dollars in securities transactions and serves as a critical component of global financial markets. Recent patent filings have outlined a modular cross-ledger framework capable of interacting with public blockchains. What's generating attention is the specific discussion around digital liquidity assets and interoperability between networks. The future financial system likely won't operate on a single blockchain. Instead, it may function across multiple interconnected ledgers. A multi-chain environment requires bridges, liquidity providers, settlement layers, and interoperable infrastructure. This is exactly where projects like XLM and XRP frequently enter the conversation. If tokenized assets eventually move across various blockchain ecosystems, liquidity networks capable of connecting those ecosystems could become extremely valuable. The market is beginning to recognize that interoperability may be just as important as scalability. Another stat catching investors' attention involves the XRP Ledger's tokenized real-world asset growth. Reports indicate that hundreds of millions of dollars in tokenized assets have been issued on XRPL, with a large percentage of that growth occurring recently. What's important here isn't merely the dollar amount, it's the trend. Tokenization continues emerging as one of the strongest institutional blockchain narratives. Banks, asset managers, governments, exchanges, everyone appears to be exploring how traditional assets can move onto digital rails. The winners of this transformation may not be determined by retail hype. They may be determined by which networks institutions trust to handle large-scale value transfer. When we zoom out, several themes begin connecting. Bitcoin is showing signs of strengthening market structure. Bitcoin dominance may be reaching an inflection point. Altcoins are reclaiming important technical levels. Ethereum faces a crucial test. Major financial institutions continue embracing blockchain infrastructure. Ripple partnerships continue expanding internationally. The DTCC is exploring interoperable digital asset frameworks, and tokenization is accelerating across the financial system. Individually, each development may seem small. Together, they paint a picture of an industry steadily moving from speculation toward infrastructure. The next phase of crypto may not be driven solely by memes and retail enthusiasm. It may be driven by payments, settlement networks, tokenization assets, and the modernization of global finance. And if that's the case, the biggest winners may be the projects already positioning themselves at the center of that transformation. What do you think? Is the market setting up for a broader altcoin expansion? Will Bitcoin dominance continue falling? And which blockchain networks are best positioned to benefit from the tokenization revolution? Drop your thoughts in the comments below. If you enjoyed this breakdown, make sure to like and subscribe. If you want to dive deeper, check out these videos here. Thanks for watching, and we'll see you in the next one.